A thank you to Camco Vest and Bergen Bank for the invitation. It really is an honor to be speaking with you. I'm sure you'd all agree that it is an uncertain time for economics. It's not just because President Trump's back in the White House. Over the last couple of years, we've had rising inflation, dealing with steeply rising interest rates, geopolitical tensions around the world, and now we begin the year with concerns about trade policy. But despite that, actual economic data has been relatively stable. Over the last 18 months, average GDP growth at a global level has been around 2.5% to 2.8% Q-on-Q annualized, despite all this uncertainty. And our forecast is for that trend to continue. So for this year and next year, we expect world GDP growth to average around 2.8%, despite that economic uncertainty. The economic data at the moment is quite difficult to discern a trend. There's enough in there if you're a growth pessimist. Survey data is relatively weak, such as PMIs, to support your view in the argument about the outlook. But equally, if your glass is half full, there's enough solid hard data there to suggest the global outlook is relatively robust. This partly reflects that a lot of survey high-frequency data is focused on industry and goods, and that's the sector that's relatively struggling at the moment, where hard data is focused on the services sector, and that is much more important to the economy as a whole. Here at Oxford Economics, we probably err to being slightly optimistic and think the resilience in the economy is going to continue. But underneath that global picture, there's several divergent stories, which we'll look at it today. Firstly, there's US exceptionalism. US growth has been really quite strong for a long time now, and much stronger than you see in other advanced economies. China is trying to offset structural weakness to maintain its ambitious growth targets, and that's an ongoing battle which they will struggle with over the next couple of years. While in the Eurozone's struggling to grow full stop, and the headwinds of the Eurozone remain quite stark. So over the next 25 minutes or so, we'll look at each of these regions in turn. We've set that in a context of how the GCC looks, and then in this times of uncertainty, we need to look at some risks and see how that can impact upon the global economy. So starting with US exceptionalism. Clearly, there's been a big change in the White House, and the economic policy is changing on several fronts. What that's done to our forecast since President Trump won the election has largely been to think the growth outlook strengthened a little bit for the US. Fiscal policy is likely to be much more accommodative. You have the Tax Cuts and Jobs Act that President Trump implemented in his first term, which were due to expire. He's almost certain to extend this. That means lower marginal rates of tax for some, higher tax thresholds, higher exemptions for alternative minimum tax rates, better child credit, and that would be stimulating the economy. Outside of the households, he'd be more supportive of businesses. So the TCGA also includes better provisions for 100% write-off of bonuses, better offsetting of interest payments, support and writing off spending on R&D. And outside the TCGA, President Trump is also likely to repeal some elements of the Inflation Reduction Act, which will be supportive of business growth over the short term. So from the growth perspective, that's the good. On the other side, which we need to set against that, is his tariff policy. And I'm sure you appreciate that's slightly a moving target as we're trying to produce forecasts. We woke up this morning to 25% tariffs on aluminium and steel imports to the US, and that was part of our forecast. What our forecast assumes is that in addition to the 10% is put on China, there's likely to be 10% tariffs on imports from the EU, as well as targeted measures such as we've seen this morning. We think that will build up gradually over the next year. So you can see from the light blue bars that really takes hold in 26, 27. But clearly, as we've seen already this year, some of those tariff policies may be implemented with somewhat of a bang and be slightly disrupting. And again, also on the negative over the long term is his immigration policy is likely to be a drag on medium-term growth. That said, we expect US exceptionalism to continue. What this chart shows is the red line is our GDP forecast for the US, and the blue line is the average of the advanced economies, so essentially OECD countries excluding the US, and the grey is kind of the marks the highest and lowest within that group. And you can see going forward that the US continues to outperform other developed economies. And it's partly due to the factors I've just highlighted. There's fiscal policy, and fiscal policy is key to explain the differences of growth across the world. But there are also a couple of other factors. Firstly, US households remain strong. If you follow the data closely, the latest payroll data a couple of weeks ago wasn't stellar. It's slightly below expectations. But revisions to previous data means trend job growth per month is 200,000, which is a pretty good clip. The unemployment rate is nearly 4%, and wages are growing well, but not too strong to cause concern amongst the Fed. So household incomes are good. On top of that, the US balance sheet is looking relatively healthy as well. So if you look at the chart on the left, you can see that US household debt as a share of income is low compared to the peers. So that means they're not burdened by debt. And the change in housing equity over the last 5 to 6 years has been relatively strong and benefited all income levels. So this is not just the top percentile benefiting. And that will continue to drive consumption growth in the US. Similarly, I would sustain the difference is there's much stronger productivity growth in the US. If you look towards the grey and the lavender bars, you can see that stays permanently higher over the forecast. That largely reflects the US disposition to invest, whereas the rest of the world had relatively flat investment ratios. The US is increasing its investment as a share of GDP, and that investment has been in ICT. So those sectors that promote intellectual property, R&D, innovation, that all feed through into productivity growth. And structurally, the US is just a little bit more encouraging of investment and risk and productivity growth, and is likely to outperform the rest of the advanced economies. Since President Trump's been in the White House, the asset markets have been somewhat mixed. Crypto and stock markets have done relatively well. Corporate debt has become more expensive, which is a concern on the outlook, while the dollar has remained relatively strong and even strengthened. Our forecast for the dollar is that strength will be maintained. Growth differentials, interest rate differentials are all supportive of the dollar maintaining its current value. We don't expect another surge of strengthening, but it will maintain the value where it is. So all in all, a good story, a positive outlook for the US. Now kind of moving on to areas where we have a little bit more concern, starting with China. China had a remarkably strong Q4, despite me tying this up as a concern. Growth of 1.4% Q-on-Q, over 6% annualized, helped the Chinese achieve their 5% target. Who would have thought? And the authorities have tried to mark that out and push it down to fiscal support. And the authorities have been relatively positive and supportive both on the fiscal side and the monetary side. But there are a number of one-off factors that helped boost. There was good weather, exports are kind of surging ahead of production, and temporary factors that are unlikely to persist. If you look at the data, the story we've been seeing of strong production, weak domestic demand, that continued. So over the turn of the year, industrial production was strong based on autos and electronics, whereas retail sales, as you can see from the chart on the left-hand side, continues to decline. And one concern about the industrial production data, so production remaining strong, is China's producing and doesn't always have a market for those goods. So that has two issues. One, they dump on international markets, which is not really helpful in the current situation of heightened trade tensions, but they're also building inventory. And eventually that inventory has to be sold to meet market demand, and production will ease. In order to sustain growth, China really has to focus and boost consumption, which is difficult. We have a situation where there's deflation, which is never good for demand. Income growth is relatively weak. Households are hobbled by the housing property market, and it's really difficult to move things forward. Retail sales are only being boosted by the Chinese trading policy, which is benefiting the sales in household appliances and sectors like that. Outside of that, demand is really quite weak. So what China needs to do in order to get anywhere near 5% growth again is really support the economy fiscally on top of the monetary policy we saw in Q4 last year. So there's this 2 sessions in March where we expect the Chinese authorities to have a significant expansion of borrowing to support demand in the economy, a third of that going for consumption. And that's likely to see the budget deficit in China rise to about 10% of GDP. On top of that, they've expanded the trading program, expanding it to the electronics sector, and you can see that pushes up the economy by 0.8% this year. However, that's not enough to offset the headwinds. Firstly, US trade policies targeted at China. We've seen the flat 10% President Trump has added. The Chinese authorities have responded, but if you look at the announcements, we think they're trying to avoid a trade war. So the tariffs, they've put 10 to 15% basically on energy stuff, a bit of automobiles. But to give a context, the average tariff rate applied to all imports to China from the US has gone up by 2%. So not really suggestive of they're ready for confrontation. But it really is a space that we need to watch. And the Chinese authorities have a long way to go to solve the housing drag. There's a massive overcapacity in the housing sector. Policy they tried to implement last summer failed, and it will remain and continue to be a drag on the economy. So we therefore think the Chinese economy is going to expand around 4.6%, just below that 5% target they've been aiming for. And moving on to Europe. The European economy stagnated in Q4. That probably overstates the pessimism. Partly the data has been moved around by the Olympics that boosted Q3 and fell out of Q4. And Irish data is incredibly volatile and can have, for such a small country, quite pronounced impacts on overall Eurozone GDP. And that was a drag in Q4. But that said, momentum in the economy really is quite lackluster. We expect growth to pick up gradually. So GDP growth was about 0.8% last year, should rise up to about 1.2% this year, driven by consumption as household incomes improve on the back of falling inflation, and that would drive the economy quite significantly. And investment. There's a lot of interest rates cuts coming through the pipeline in Europe. The ECB has already been active in the second half of last year into this year, and we expect kind of sequential interest rate cuts through 2025, and that will boost investment. However, in contrast to the other areas I've just been speaking about, China and the US, monetary policy and fiscal policy aren't working in sync, and fiscal policy is likely to hold the economy back. But however you cut it, or slice and dice it, the Eurozone outlook is going to live and die by developments in the labour market. And there are some worrying signs. These charts show that employment expectations, household unemployment expectations are negative, and this could unwind the positive outlook we've got for the Eurozone. We think there's enough vacancies, there's enough demand out there, so we're not too worried, but it's a risk that's worth flagging. And if you look across the Eurozone, it's very much a two-speed economic zone. You have most of the Euromed, so Spain, Greece, Portugal, growing strongly. Spain was the strongest performing developed economy in the world last year. And then you have the core, which is really quite suffering, Germany, France, and Italy. And there's a couple of main reasons for that. Firstly, the Euromed as a whole is more dependent on services than industry than the core of Europe. And it's those services that are robust in industry that's suffering in the current climate. And secondly, Euromed benefits from tourism. And there's been a significant rebound in tourism, and it continues post-COVID, and that's likely to continue to strengthen demand. So where do we sit here in the region? I think it's fair to say the GCC will once again be a standout economy in the global ecosystem. Now, looking at the headline rate, that may be obscured somewhat given the importance of oil and how oil production has been developing. Over the last year or so, oil prices have really struggled to maintain 80 plus barrels of dollars per barrel, which a lot of the countries in the region need for break even. We've seen a situation where oil prices are around $75 a barrel nowadays, and that is despite remarkably good discipline by OPEC+. They've stuck together, they've held production, they've extended production cuts, and despite this, it seems very much to be a demand story. The markets worry about demand concerns, and that's holding back the oil price. Our forecast is that oil price will trend down from current levels over the next year to end the year just above $70 per barrel, largely dependent on looser supply conditions, drill baby drill, as President Trump says, and that's likely to weigh on oil prices. And as a result, oil production in the OPEC plus countries, the cuts are likely to be extended. We think it's unlikely before the second half of the year that production will rise. That said, the non-oil sector is growing strongly. Saudi economy, the private non-oil sector, was growing about 4.4% last year, up from the year before. We don't have the full year for the UAE or most of the area, but the UAE could come in at just under 5% non-oil growth. And as you can see from the PMI survey on the left-hand side, the underlying trend is positive, and Saudi PMI, for example, it reached its highest level in over 10 years. So really suggesting that underlying growth continues to be strong. So what will drive the forecast going forward? The oil sector will be positive again, even if oil production only increases in the second half year. It will make a small positive contribution and then go through and continue to benefit the economy next year. We're going to benefit from a situation where there's slightly more relaxed monetary policy. The Fed Reserve has already cut interest rates by 100 basis points, and even if there's not many more in the pipeline, that will gradually feed through and benefit the economy. Here in Kuwait, you have less benefit. You follow a slightly different monetary regime, so the cuts have been less so far, but that only really offsets the fact that the Kuwaiti central bank didn't increase interest rates as much during the tightening cycle. But as I highlighted earlier, what really explains the difference between growth across countries is fiscal policy. So it's become harder for the countries in GCC. Revenues have fallen short, oil prices are lower, production is flat, and as you can see in the chart on the left-hand side, a number of countries have slipped into deficit. But the public finances across the GCC tend to be in good shape. If you look at a chart on the right-hand side, Most of the countries have a debt to GDP ratio of less than 40% of GDP. And if you look at those charts, the economies of the EU would probably love those fiscal picture, and there's a relative strength and robustness that will help the economies continue to support, the governments continue to support the economies. And as a standout growth area, the GCC is attractive to investors. Firstly, governments continue to have good access to capital markets. Good fiscal discipline is seeing credit ratings improved across the region. Already this year, Saudi Arabia and Oman have seen their credit ratings increased. And they're starting to tap capital markets. After issuing $12 billion in debt last year and $5 billion sukuk by Saudi Arabia have already front-loaded borrowing, issued another $12 billion in debt this year. And across the region, that access will continue. And on the right-hand side, it is a hotspot for investors. IPOs across the region, whether that's in Saudi Arabia, Abu Dhabi, Dubai, Muscat, continue to strong and pull in finance. And that's allowing the countries of the region to continue to support the economies. So that broader public spending is an important driver, whether it's in Saudi Arabia for Vision 2030, and then spending that will be associated with Expo 2030 or the FIFA World Cup 2034, whether that's in the UAE with investment to support UAE 2031, or Qatar spending to develop LNG infrastructure. And here in Kuwait, you have 23 billion dinar of projects announced, and last year there was a record amount of projects announced and approved within the Kuwaiti economy. So that Vision 2035 that's been developed is really starting to drive growth and to drive the transformation that we heard about at the outset. So that means strong growth across the region. We expect Saudi Arabia and the UAE to be the strongest performers, but solid growth and growth that outperforms most other regions of the world across the GCC countries. As I started at the outset, we are in an environment of rising policy uncertainty. At Oxford Economics, we undertake a survey of our clients to see what they're most worried about. And there's two kind of stand out. First, we try to sense, are they optimistic or positive? What are they worried about growth exceeding or falling below projections? The majority of our clients think the risks are skewed towards the downside, and if these policy risks unfold, it's likely to be a drag on growth. And these risks that are listed on the slide are what most concern people. Firstly, a global trade war. That's the single biggest worry. And then there's worries and tensions around the geopolitical tensions, whether it's here in the Middle East, Russia, Ukraine, or potentially evolving to Taiwan. And then there's concerns about monetary policy and tightening. So if we start off looking at the elephant in the room, what's going to happen with tariffs. As I said, it's quite hard to be certain here and quite hard to get the timing of these tariffs right. What we have at Oxford Economics is our global economic model, which enables us to run alternative scenarios to assess the economic impact of different policy choices and different shocks. What we can see here is how the tariff scenarios potentially ramped up. In our January baseline, which obviously we're updating as we speak, we have a modest rise in US in tariff rates. The tariff proposals are what President Trump announced on February 1st. So technically they're not his proposal now, but that included 25% on imports from Mexico and Canada, which is paused for a month, and the 10% that we see on China. And then we've also modeled a more extreme case in a situation where you move towards a trade war, which is 60% on imports on China and 10% on all imports from the rest of the world. And of course, in these scenarios, the rest of the world respond in kind. And what does that mean for the global economy? The current tariff proposal would hit the US really hard this year, have some rebound and bounce back. But the bigger, longer-term impacts are those ones which move into a trade war, so the 6% on China and to 10% on everyone. And if in such a scenario, over the next 3 to 4 years, you could see GDP in US, Canada, Mexico falling by 1.5% to 2% compared to a situation where we didn't have tariffs. And in Europe, that impacts 1%. So really quite significant and pronounced impacts on the global economy, and negative despite the justifications and the reasoning. One of the consequences of tariffs is inflation's likely to be higher. So inflation could go back above 3% with the current proposals if President Trump does implement tariffs on Canada and Mexico. But even then, over the next couple of years, they build up and get higher in a situation where he imposes tariffs on China and the rest of the world of 60 and 10%. And what that makes it much harder to do is for the central banks of the world to cut interest rates. We've already taken out 2 interest rate cuts from our Federal Reserve forecast. So instead of the 3 interest rate cuts during the course of 2025, we had at the turn of the year tariff policy and stronger economic data, meaning we think the Fed's going to be on hold for most of 2025 before cutting in December. And even in the ECB, where we have a much weaker economy, they're presented with a dilemma. They're likely to cut rates over the next couple of meetings and then weigh up whether inflation or growth is the biggest threat, and ultimately come down to make further cuts later in the year. But even without interest rates rising, there are tighter monetary conditions. What we've seen over the last couple of months is a rise in bond spreads, a rise in government bond yields. This doesn't really reflect inflation. It's not an inflation risk premium, we think, but it's an uncertainty premium. And those higher interest rates will feed through the financial system, affect the cost of borrowing, weigh on asset markets, potentially hit on to the value of the dollar, all factors that will weigh on US growth. And what we've done with the same Oxford model I've mentioned a couple of times is run a couple of scenarios. And we've looked at what happens if bond spreads rise by around 125 basis points, which is similar to the tightening cycle we saw in the 1990s. And what happens in a severe case when that increase is actually 250 basis points, steepening of the yield curve, which reflects what happens in the 1980s. We think the moderate scenario is the most likely outcome, but by having the severe and the moderate, it helps us bookend the outcomes. And you can see that that can knock off 0.5% of US and Canadian growth over the next year and have a meaningful impact on the economic outlook. I won't read through all those numbers, but I'll leave you with a slide which is our latest forecast for the major economies of the world and the GCC included. And just for a few thoughts to wrap up, we expect continued steady growth through 2025 and into next year. Tariffs are a significant risk to that outlook, but they're not a catastrophic risk that's likely to tip the world in recession. Underpinning the global outlook are 3 very different stories. 4, I guess, if you throw in the GCC. You have US exceptionalism, China's battle with domestic structural weakness, European malaise, and the GCC's standout performance. The decline in interest rates, with the exception of Europe, is likely to be modest. And as I've mentioned a couple of times through this presentation, what's key to the outlook and differences is fiscal policy. And that's where the GCC stands in a good position, as does the US, as does China, and it helps explain the European malaise. So fiscal positions, although tight in the GCC, we're still unable to do growth and diversification policy, and the risks to the outlook are predominantly trade policy, geopolitical risks, inflation remain something we should look to watch. So with that, I'd like to thank you for your attention, and hopefully you found it interesting. And if you have follow-up questions, then please speak to me during the interval, and I'm happy to discuss anything in more detail.